What's up, guys? Welcome to Roensch Capital Charts. Today we're taking a look at the ever so popular S&P 500 ETF SPY, ticker symbol SPY, on a variety of time frames in anticipation of the next trading day, Thursday, May 2nd. All right, guys. Hey, listen, big day here for the market, therefore a big day for SPY. We finished the day relatively underwhelming, right? It's minus $1.63. That's minus 0.32% in regular trading hours. We'll see how after hours plays out here. However, listen, as is typical, after hours tends to be low volume, so take that after hours movement with a grain of salt when we do see it. But today was obviously a very big macro day, as expected. The Fed left rates unchanged. This is nothing new. I've been talking over on the main channel for at least 6 months how, you know, May was already a long shot months and months and months ago to start seeing rate cuts. Okay, and the market knew that. So after we got the news, there wasn't a ton of volatility. What ended up driving things is we had Powell come out and say he basically ruled out any more rate hikes. He said he sees it as unlikely that their next move will be a hike, which leaves cuts as the default. You know, honestly, guys, I was semi-surprised to see this big pump. I wasn't surprised after we got the pump to see the big fade, because to me, this was relatively obvious, and I think this was obvious to a big chunk of the market, that hikes, I think it's very unlikely that hikes are on the table, unless, of course, we see astonishingly bad inflation data to the point where it was so unexpected that they have to be back on the table. The Fed likes to work as smoothly as they can. Okay, it's not very common that they're going to pause for many meetings in a row and then pull another rate hike out of nowhere and then just start cutting. Right? That's sloppy policy, really. But as we've also been discussing for, man, it feels like a year now, but it's probably been at least 6 months. When the Fed talks, they have to leave every option on the table, okay, just in case something crazy happens, then they don't have to go back on their word. So Powell saying, I suppose, that they're essentially cutting out, well, he said it's unlikely that they'll see any hikes. That got the market excited. The market pops, and then once reality hits, a few more comments are made, it fades, okay? Again, the fade is, to me, not all that surprising. An example of another comment made, he said, quote, "In recent months, inflation has shown a lack of further progress toward our 2% objective." Which, again, at this point, even before he came out, we kind of already knew that. Just remember, guys, the Fed is going off the same data we all are. They're looking primarily at core PCE. They're also looking at regular PCE, headline PCE, right? And then CPI takes a back seat, but they do look at CPI, of course. The market tends to look at CPI as more important than the Fed actually does, which I've always thought is kind of interesting and a little bit backwards. But CPI is, of course, the big headline read. They're going to look at core CPI first and headline CPI second. Whereas it's a little bizarre. The market tends to look at headline CPI as like the, gold standard for inflation read, whereas really the Fed is looking at core PCE. So that's what I tend to pay more attention to. So let's do everything we can here today, guys. We're going to pull out as much bias as we can. We have a lot of volatility to look at. We're going to, of course, do the volume profile analysis. We're going to take a look at the psychological levels that we all need to be paying attention to here tomorrow. We're going to look at the directional bias out of the chain and finish off with expected move. Now, last macro thing here today, I promise, but this is a very busy couple of days. Tomorrow morning, 1 hour before the market opens, that's 8:30 a.m. Eastern time, we get U.S. initial jobless claims. We also get factory orders month over month at, it's going to be 10 a.m. Eastern time. But the more important volatility read here tomorrow is going to be, again, that 1 hour before the market, before the opening bell. And that's the U.S. initial jobless claims. The forecast is 211,000. The previous was 207,000. That is a weekly number that has been especially important in the last year or so, given the current state of inflation. Or more accurately, I should say, the policy, right? It gives us a read on how policy is going. So let's dive in here. Okay, we'll start with the volume profile here on the 5-minute. Really what we're doing, guys, again, if you're new here, by the way, if you are new here, please subscribe to the channel. My goal here is 10,000 subscribers. We recently set a goal of 7,000. We blew that away with quite a bit of time to spare. So again, thank you guys. I appreciate you subscribing to the channel, and I will keep the SPY videos coming. But really what we're doing here is we're looking at the volume profile as a separate entity compared to the price action, right? Because the price action, we can all see it, right? We know what happened. It's done. It would be hindsight. It's not really worth just simply looking at the price action. We know where the price went, okay? But we need to peel back a layer of the onion because more data can be found by looking at the profile. So for context here, if you're a bull, your ideal scenario, your best case scenario would be to see massive bullish bias and then very little bearish bias on the drop. If you're a bear, you want to see very little bias on the rise and massive bearish bias on the drop. Okay, this is really what we're going to look at because that's after the more recent data that we've got. So let's take a look. Once the pop really began, guys, you know, this is really interesting because we have two out of context. Well, it's a news day, right? So saying out of context is probably a little bit inaccurate. But compared to the surrounding volume, we have two somewhat out of context green bars on the biggest push bars on that front side of the move. However, this is where we need to look a little deeper. Okay, because see this first bar that makes it 2 bars of out of context volume? See that massive wick? Okay, that tells me that that first bar was a big battle bar, and it likely had a lot of sell orders going through just as much as buy orders, and the buyers eventually won. But volume, of course, considers both buy and sell orders, right? And we know that those were there because the giant wick. So for me, I'm uncomfortable assigning any kind of bias on this front side move really at all. We had bigger volume right at 1 o'clock Central Time. That was when the FOMC decision hit, of course. That's expected. We saw it fade off. And then we saw kind of a mixed bag in volume with a battle bar that creates kind of an illusion of massive, not massive, but a little bit of bullish bias. It's more an illusion than anything. And if I don't remain unbiased, what are we really doing here? Now, bears, though, on the backside of the move, in a similar fashion, you don't really see any bias at all until we get into that last 10 minutes of the day. Remember, this is the 5-minute chart. But some increase in volume is expected. You know, you look here at yesterday, we saw almost just as much volume on that same bar yesterday as we're seeing here today. And today was a news day. Okay, so this little increase here, that's relatively normal. Now on SPY, you have to understand that usually on the blue chips, we see really big volume immediately after the bell. That's the funds and institutions doing their rebalancing. It triggers with an algorithm after the bell rings, right? On ETFs, like on SPY, for example, we typically see that before the market closes. It's been very consistent, especially as of late. So seeing high volume right before the market closes, this has been very normal. This isn't original to just today. So if we adjust for that context, I gotta be honest, guys, there's really no bias in either direction, which I think is really interesting, because when you get this much volatility, it's typical to see one side when really you end up with kind of a net neutral move where nothing really happened by the end of it. You typically have one side outshining the other. The market doesn't really know what to make of this, at least not yet. But listen, we're not dead in the water. We have more data that we can pull out to really find the market's opinion, because this is bizarre to see almost no bias with a net neutral move with that much volatility. It really is interesting. Let's move on here. We'll get to that other data, but first we need to take a look at the psychological levels so that we're aware of what the big money and the traders are paying attention to here as far as psychology on the charts tomorrow. So this is the 30-minute chart. And you can see here that when it was all said and done, we ended up in a similar situation as we were already in yesterday. Below both moving averages, we attempted to reclaim not only the 50, we actually attempted to reclaim the 200 period as well. We faded off both of those and ended up below each. So listen, looking ahead to tomorrow, bulls, my primary objective here, I want to see a reclaim of that 50 period at least. It would be great to see a reclaim of both the 50 and the 200 period here on the 30-minute, but the 200 period is 1.2% away, and anything over 1% in total movement on the day on SPY is a little bit less common. Anything over 1 is typically a more volatile day. So really what I'm looking for, since we're kind of hanging out right around that 50 period, if I'm a bull, I want to see a high volume break. Whether it's pre-market or the intraday session, pre-market's not likely to be high volume, but I want to set it up to get an intraday back test of the level. Again, whether we break pre-market or intraday. If it's intraday, I want to see volume high on the break. If it's pre-market, I don't care. A low volume retest I want to see during the actual session, and then a high volume bounce. That gives us a good sample size with a lot of volume to take the opinion of. Whereas bear is really simple for you guys. Any upside test that 50 period here on the 30 minute in particular, I really want to see that just reject. Again, I don't care what volume it tests on. We're already below it as of right now. I would want to see that reject hard on high volume. Okay, the rejection on high volume. The test itself for bears, I don't really care. All right, now the 4 hour. Let's take a look here. We attempted again today to reclaim that 50 period after giving it up yesterday. Unable to do so. Now that is currently, as of right now, we're looking at about 0.75% away, about 0.7. So, you know, that's within reason for a single day. We could see that, no problem. You know, we've seen crazier things on SPY as of late. Even plus or minus 1% or more days have been a little bit more common than they usually are on SPY lately with added volatility. So a similar deal as on the 30 minute with the 50 period. Again, bears, any test of that, you want to see that reject hard as possible on as much volume as possible. Bulls, high volume break, low volume retest, high volume bounce to claim that 50 period on the 4 hour chart as a short-term support level. Okay, now the daily chart. This is the most important chart of all. You take a look here, and we got up within a couple of points actually of that 50-day moving average. By the way, the 50-day guys, that white line, this is on like everybody's chart. Okay, this is very common, and it feeds into that self-fulfilling prophecy mentality, right? That short-term psychological approach. Now, listen, the 50-day moving average, it of course, similar situation as the 30-minute and the 4 hour. I won't explain it a third time because you've heard it twice by now, but I am also not going to explain it because there's a much more immediate concern here. You see what it is? $500 a share is the battle tomorrow. Tomorrow's the battle of 5. It really is. Bulls, we talked about this yesterday. I want to see 5 hold. Bulls kind of barely held it today into the close. All right. I want to see $500 hold, and ideally a high volume bounce up and away from that level to put some distance in between the stock ETF really and 500, because that's a huge psychological, therefore technical level. As the psychological levels become more and more obvious, 500 is already insanely obvious to everyone looking at it. They tend to turn into technical levels, don't they? And that also happens vice versa, by the way. Technicals also turn into psychological levels when they become obvious enough. And now you bears, again, number one priority here tomorrow, break back down into the 4s. Okay, and hold. Ideally getting a high volume breakdown through 5. Kind of one of those like high volume, I'd say kind of like panic bars. You know, intraday, you see those sometimes when you break a big level, the volume pours in, everyone fumbles all over themselves to either sell or buy, depending if you're breaking down or up. You bears would want to see one of those with a low volume retest of $500 a share, and then a high volume rejection back away, downside, to kind of claim that as resistance and kind of prove itself intraday. Now, implied volatility here on SPY, basically unchanged from yesterday. You know, again, compared to the last couple of months, it's in, I would say, the mid to probably higher range if you're comparing it actually to the last few months here. If you're comparing this just to the last, 3 weeks or so, you're probably about in the mid-range. Okay, context is so important. Context of time frame is what I mean when I say that. For implied volatility, you have to say, am I buying contracts for 6 months out, a year and a half out, or for next week? And then look at where IV lies in relation to your intended trade time frame, like the past for how long you're looking to go out, that region. Because how you position yourself in terms of implied volatility when you buy the contracts or sell them, okay, is also a huge factor in whether you're profitable, not even just in the long term, of course in the long term, but also just on that trade. All right, now let's do expected move. One thing I do want to do before we do that though, I want to take a quick look here just at my 1 minute chart, just to show you guys the volume weighted average price. My volume weighted average price on all of my charts, just so you're aware, Well, not all the time frames, but in every video I do, it's always going to be that blue color. That right there is volume weighted average price. And on the 1 minute chart, you guys know how I talk about, like, the 50-day is huge on the daily chart. The 1 minute chart, the most important possible indicator that I use, if I could only have one indicator on any of my 1 minute charts, it would always be the volume weighted average price, because it's real, but not just that. It's because everybody uses it. Every trading firm teaches their traders, I'll say most trading firms, the vast majority, teach their traders to at least have volume weighted average price on their chart so they're aware of where it is. That doesn't necessarily mean they have to use it, okay? But it is something to be, it's like a psychological anchor. Where is everyone else looking? That's why I have it on my chart. It's not so that I can trade every tiny little bounce off of it on SPY. And believe me, I tried that for a couple of years and it didn't work long term. I had no edge. But I still have it on my chart. And you have to fight to end up on my chart. And it's still there. Okay, because it's the most important, because it's the most popular on the 1 minute. Aside from, like, volume, of course. It's the most popular line, I'll say. And you look here, you had an exciting time here when we were pulling away, really willing to pay up well above volume weighted average price. Now, something that a lot of people don't understand about the volume weighted average price is that it's actually very heavily used as a fluff tool at funds and institutions who are trading for clients. Okay, because when you can report to a client that they told you to buy such and such stock, or you told them that you were going to start buying such and such stock, and you can report to them a day later and say, hey, look at all this stock we got below volume weighted average price. We paid lower than, quite literally, the volume weighted average price. People always like to get the better deal than everybody else, okay, or at least the average. So in the industry, that's a very common thing to use to make yourself look good. Or you can say, hey, we were trimming that stock. Remember we told you we were going to trim that stock? Well, look at what we ended up getting on the sale compared to the volume weighted average price. Look at how much better we did than everyone else. Okay, it's a very stupid, simple way to make yourself look good to clients. So if they're using it, I want to use it too. I just want to be aware of where it is, because I know that people are trading off of it the same way that I tried to do blindly for a couple of years. I know that that's the case, and it's probably the case more so on the volume weighted average price than anything else. All right, now let's do expected move. Okay, again, we have the luxury on SPY of not only daily expirations, but we had all that news hit while the market was still open, of course, so we have updated data in the chain. Next expiration, of course, is tomorrow, May 2nd. And the expected move by tomorrow's close compared to today's closing price of 535 is plus or minus $3.77 per share. Now remember, guys, that's quite literally being priced in by the traders. It's the one standard deviation expected move. It's the expected volatility being priced in by the market. By design, there's no directional bias baked into the quote-unquote expected move, right? That's on purpose. It's the volatility expectation, which is a part of the puzzle that I think so many people ignore. But ignoring that is like reading the top half page in a book you're reading, and then you flip to the next page after reading the top half. It's just, you're missing such a huge part of the picture if you're ignoring volatility or the market's expectation of volatility. Especially if you're trading options, you are missing half the story. Only having a directional bias in options is not good enough. And I'll tell you what, it's not difficult enough to understand the volatility expectation and how to trade that. Like when we talk about implied volatility and Vega and expected move, that's what I mean. It's not hard enough to understand. You can learn it in less than a weekend. It is not difficult enough to excuse and say, well, I'm just not going to mess with that. I'll just have my directional bias and maybe I'll make some money. It's too simple and too much of an advantage to ignore. So listen, last thing we can do here, though, to pull out some directional bias coming from the market here today in SPY, we have more so, all of today's options volume. This is all from today. We had 8.67 million total contracts traded, 3.76 million were calls, and 4.91 million were puts. So we're seeing a bearish ratio on the overall call put ratio. And if we break it down by time frame, the short-term speculators in that 0 to 20 delta range, we have 1.45 million calls and 2.33 million puts. So we're also seeing a bearish bias out of the short-term speculators. Listen, guys, again, SPY is a daily upload. If you're getting value out of these videos, I ask you to do one thing. It's 100% free, and it takes half a second. Please just leave a like on the video and then get out of here and enjoy your day. I appreciate it, and I'll see you in the next one.